Good evening all, and thank you for joining our Audit of Cryptocurrency and Data Analytics webinar. My name is Aluta Ganiwe, and I am a Marketing and Business Development Professional at Mazars. We are joined by the following speakers. Richard Ball, who is the lead data scientist at Luno, specializing in fraud detection. Richard has over 10 years of professional experience in data-related roles. Richard is currently completing his PhD in machine learning at Northwest University. His current area of interest, at Luno is using on-chain data to understand transactional behaviors. Our second speaker is Dinesh Gurla, who is an Associate Director in IT Audit at Mazars. Dinesh is currently involved with managing data analytics, IT audit, specifically IT general control reviews, application control reviews, risk assessments, and other ad hoc assignments. His client experience ranges from owner-managed businesses in manufacturing, retail, private equity, cryptocurrency, and a multitude of JSE-listed clients. Our third and final speaker is Vian Olivier, who is a partner and digital asset lead at Mazars. He has been involved in the digital assets industry for over 4 years, which stemmed from his involvement in various industries that includes financial services, property, and private equity funds. Vian has completed a blockchain and innovation course through MIT and is currently enrolled for MSc in digital currencies. His experience in crypto industry include consulting and assurance engagement services for cryptocurrency exchanges, cryptocurrency custodian wallets, stacking, ERC20 stablecoin and fund structures, and cryptocurrency bundle investment platforms in South Africa, Singapore, the US, and UK. On today's agenda, our speakers will unpack the role that big data plays for virtual asset providers, how the providers go about managing and securing it, and how we as Mazars audit this data. Please feel free to send your questions through during the session, and our speakers will get to your questions during the Q&A towards the end of the session. Thank you. Over to you, Richard.
Thanks so much for the introduction, Aluta, and hi to everyone in the audience. Welcome to my talk on data analytics. I'm Richard, the lead data scientist in the data team at Luno. So there are 3 sections that I'd like to run through today. Firstly, we're going to look at big data in the crypto industry and some of the challenges that we see at Luno. I'll then speak about how we ensure the integrity of our data. And finally, we're going to take a look at data privacy and some of the mechanisms that can be used to assist with data privacy. So starting with big data in the crypto space, you might find that some of the challenges that I list are not too far removed from the challenges that most fintech companies will face. And so a number of you may see many similarities with challenges within your own organizations. Right, so challenge 1 that we're looking at is around the proficiency of our users. So as you can imagine, we have a mix of internal users at Luno who all have varying degrees of data proficiency. So one of our aims is to provide our colleagues with a self-service analytics portal where they can access and use data in whatever detail they require. And we use Looker as a tool to facilitate this, where users can go in and query data and build dashboards from the front-end user interface. We as the data scientists in the team build the back-end logic that supports this self-service interface for our internal colleagues. But we face an issue where if we give users access to too many data fields at any time, some of the fields might fall out of context and therefore cause a bit of confusion for our users. And conversely, giving users access to too little data limits them, especially if they're proficient with data. So there's this constant trade-off between providing too much or too little access to data. Challenge 2 relates to the relevancy of our data. So we have a number of third-party integrations which provide us with data relating to the specific problem that the integration is obviously aiming to solve. An example of this would be our customer CRM solution. So we have changed our third-party solution for this once before, which leads us to an issue where how do we keep the data from that previous solution? So naturally, the data is relevant for the point in time where the former solution was in action, and it would provide useful metrics about the state of our customer servicing at that point in time. But at what point do we archive that data and then focus only on the data from the newer solution that we've adopted? We see the same problem with our internal data, where we may have tables that never get queried or which never get updated. And the unknown here is that at what point do we sunset the data if we choose to sunset it at all? Challenge 3 is around the growth of our data. So it's no surprise that Luno is obviously growing a lot, and we intend to continue to grow as we enter new markets and geographies. I've listed some examples of the size of our data tables in the slide, some of which are now terabytes in size, which is obviously massive. Our traditional data stack, which entails using a standard analytical database or a data warehouse, hasn't necessarily scaled to support these enormous tables. And so we've pivoted to a different approach, which makes use of Spark, where Spark is just a technology that allows us to process data over multiple machines, which is more efficient than processing data over just a single machine or a single cluster, effectively. Challenge 4 is around maintaining the freshness of our data. So our data processes don't always exist in isolation, but rather many of our tables rely on the availability of other sources or other upstream sources of data. Therefore, there are naturally dependencies between our data sources. And depending on the area of our business, some departmental functions might require updated or very fresh data far more frequently than others. Examples of this might be our financial crime team or our payments teams, who really want their finger on the pulse and to see what's happening in real time. While we'd like to obviously provide everybody with real-time data, it's not always possible, typically due to the dependencies that I've mentioned. And we're also confident that our newer Spark platform that we've adopted will help to improve the freshness of our data dramatically. So the fifth and final challenge that we face is around tool selection. So we don't select tools at random, rather we select them in order to solve some of the previously mentioned challenges. Initially, our data stack worked very well, which involves using Looker as a data analytics and dashboarding tool that sits on top of our Redshift data warehouse. And these two technologies integrate very well together. But we found that as the size of our data increased, it became difficult to meet some of the previously mentioned challenges. So now that we've started migrating our workloads into Databricks, which is a managed Spark platform, we've seen some remarkable improvements, an example of which whereby we have a specific table that we could only ever store 30 days worth of data, and now we can store and query the full history of this data set, which is over 3 years worth of data. So that's quite a remarkable difference. Okay, so next I'd like to cover how we ensure the integrity of our data at Luno. So when we say data integrity, what do we actually mean? The textbook definition is the process of maintaining accurate and consistent data throughout the data lifecycle. And there are a number of ways that we aim to ensure integrity of our data. And I'll cover some of these in more detail over the next few slides. So firstly, database design is important for ensuring the integrity of our data. A common practice that we follow involves making use of both production and analytical databases, where a production database is the database that the actual live events get written to. So if you're on Luno, you're making use of our product, whatever actions you take are going to be stored in our production database. And the production database is optimized for writing to the database. So it's important that we don't have our internal users running queries against this database, as it may impact the performance of our product, which is obviously a no-go for us. Instead, we rather store sanitized copies of the production data in an analytical database, or commonly known as a data warehouse, which is optimized for querying. So therefore, it's safe for our internal users to query that data. So overall, our process is basically to keep the real production database as is, then to make a replica copy of this, which may contain some of our sensitive information, and then to have a final warehouse that contains no sensitive information at all, which is safe for our users to query, and then they can build dashboards on top of. We also make use of what we call the medallion architecture, which is basically a way to layer your tables according to certain criteria. So at the lowest level, we have what we call the bronze layer of the architecture, which contains all of the raw data that comes from our source systems. This data is not aggregated in any way and it typically contains most of our sensitive data. Some examples that you could think of is like, raw CSV files or JSON files and things like that. Then on top of that, we have the silver layer or the middle layer of the architecture, which is a processed or a refined version of some of those bronze data tables. And this layer can be queried directly by our business users in some cases. And the data here is still flat, which means the single tables basically exist in isolation. They're not joined or anything like that. Then finally, we have what we call the gold or the highest layer, which is primarily data that we use for business consumption. So this data is highly aggregated, it contains lots of joins between underlying silver tables, and typically serves as the input for things like dashboard creation or machine learning models. So as mentioned earlier, while we are migrating to a Spark environment, we still maintain our original Looker to Redshift data stack. And traditionally, these two tools do work well together and they allow our users to build queries quite quickly by facilitating the building of what we call temporary tables in anticipation of users needing to query them. So as an example, we might have a schedule that pre-builds a data source early in the morning at say 3 a.m. in anticipation of business users wanting to query that table kind of the first thing in the morning, so as they arrive at the office at 8 a.m., for example. And the previously mentioned medallion architecture also comes into play here, and it works nicely to ring fence some of the responsibilities within our data teams, where our data scientists are typically responsible for that final gold layer, which is closer to our business, while the data engineers at the company typically are responsible for the bronze and the silver layers. We also adhere to a number of best practices in order to maintain integrity within the company, data integrity specifically. So these involve things like maintaining adequate documentation through the use of effective labels and data descriptions, both which guide our business users towards the right data, which is in line our push for self-service analytics. And we also perform formatting of data according to particular criteria. So for example, should our exchange volume data be denominated in US dollars or in crypto values or both, for example? The correct scoping of the solutions that we devise is also important, but as they're typically built for purpose, although we do encounter scope creep, as some users tend to request more and more features on top of what they've originally requested from us. And then finally, referencing becomes quite important. And so we're constantly trying to figure out the best way to ensure that any new data types that arrive in our data, that they're automatically updated across our new data models, instead of us manually intervening and updating kind of static mappings within our data. Right, so the last section that I'd like to speak about is data privacy and how we ensure this at Luno. So PII, or personal identifiable information, is front and center for us at the company. PII relates to data that can be used to identify our customers, both indirectly or directly. And depending on the jurisdiction, we're required to remove PII data from our databases and only collect what is necessary in the first place, right, in order for us to operate. So some of the mechanisms for removing PII data that we do have at our disposal include things like the automatic removal of PII data, the manual removal of PII based on an ad hoc request, or we have the option to anonymize data. So for example, we could obfuscate or scramble an IP address. Then from a data storage perspective, again, we leverage the medallion architecture. This entails keeping any PII data in our bronze, and to some extent that's that silver layer that sits in the middle. And then we have no PII data available in the business-facing gold layer. So it's safe for business consumption. And this works well as we know where the PII data sits naturally, and access can therefore be controlled accordingly. So on this slide, I've listed a few examples of PII data, and we've got examples namely related to personal and contact details, ID documents, and bank account information. So more relevant to our European markets, GDPR, or the General Data Protection Regulation, ensures that our customers are able to request that their personal data be removed from our records. Generally, there are mandatory retention periods depending on the region where we're operating. So, for example, South Africa has a 7-year retention period and the United States has a 5-year retention period, and so on. The removal action can be called upon at any time. So whatever solution we devise needs to be flexible enough to cater for ad hoc requests, as well as automatic removals based on those retention period lapses that I mentioned. The data team at Luno also act as the custodians of the data for the company. So sometimes business users request access to extracts of data that may contain some sensitive information. So for example, somebody in the marketing team might want to run a particular email campaign where they require a list of email addresses based on a number of criteria for which the campaign is targeting. So, customers from Malaysia who spend more than $1,000 in the last 30 days would be an example of a targeted campaign. And when they request this, we have a formal process for these types of edge cases where we require motivation for the requests. We want to be able to see the lineage of the requests, and all of this needs to be tracked in our internal workflow management system. And the data then gets stored onto our internal drive and is exposed to authorized individuals only, so those who requested access. Then for very sensitive information, so for things like national ID numbers or ID documentation, for example, those requests typically get routed to the engineering team that's responsible for that data. All right, so my final slide is on-chain data, which is something that I am personally quite interested in. We currently integrate with a few third parties who help to provide on-chain insights regarding risks of sending to or receiving from certain known risky crypto addresses. And these include things like risk scores and labels for these addresses. An example would be an address on the blockchain that is linked to the dark web, for instance. While this data is valuable in helping keep our customers safe, we also have the option to leverage the more detailed or granular blockchain data that sits behind a lot of these integrations. And that blockchain data, while it's a bit more complex to work with, it's very useful in helping us understand how our customers want to use crypto, which in turn helps inform our product offering and also helps us keep our customers safe from things like scams, for example. All right, that's it from me. Thank you everyone for listening. I'm now going to be handing over to Dinesh.
All right. Thank you, Richard, for those valuable insights into big data. Good evening to the audience, and thank you for being here to watch this webinar. So Richard has mentioned a lot about big data and how exchanges are managing this. Today, I'm going to try my best to not get too technical, but hopefully share some insights into how we at Mazars are auditing cryptocurrency exchanges. Before we dive into the challenges this big data brings to audit firms, I think I would just take a step back and lean into how data analytics fits within the audit methodologies. So audits in South Africa are performed utilizing the International Standards of Auditing, which we commonly refer to as the ISAs. Now, while the ISAs don't specifically mention the use of data analytics, auditors use data analytics as a tool for generating audit evidence. So a traditional audit approach will revolve around the performance of audit procedures, and this is generally done through some sort of substantive testing, which auditors like to refer to as ticking and bashing. So as the fourth industrial revolution rumbles on, there's a shift from this traditional way of auditing to what we like to refer to as Mazars as the intelligent audit approach. So this approach relies on a fully integrated IT audit approach with the view to audit and interrogate as much as we can of the data that the entity generates on the back-end systems. Richard has spoken a lot about how the data has been generated, where is it coming from, and in which environments it's actually being stored. So the challenge that comes with this is ultimately, because of the growing size of this data and using tools like Microsoft Excel is no longer going to work effectively. And I'm going to chat a little bit more into the different tools that Mazars uses to actually interrogate and analyze data. So at Mazars, our governance bodies have recognized the need for the utilization of data analytic tools. And as a result, our Mazars audit methodology team, which is global based, developed our own MADAM. So MADAM stands for the Mazars Audit Data Analytics Methodology. And this methodology is used by all officers, by all Mazars officers around the world, ensuring that the data analytics procedures that we perform conform to the highest quality control. We've also recognized the upsurge in the use of robotics, process automation, as well as artificial intelligence. And as a result of the need to audit these tools, Mazars has developed their own guidance document on the auditing of these tools. The key challenge that audit firms are experiencing when working with this big data is firstly the size. So where do we host this data and how do we interrogate it? So secondly, it's a combination of, do we have the right technical skills in-house and the right applications to allow interrogation of this data? So auditors would typically deploy some form of substantive data analytic audit procedures to this data. And what this means basically is that the entire population of the data will be subjected to the test, thereby virtually eliminating the ticking and bashing I mentioned above. Like Richard mentioned before this, data sizes are exponentially growing. As a result of this interrogating data at Mazars, we utilize tools like Microsoft SQL and ACL, and this is becoming a daily occurrence as companies, not only as cryptocurrency exchanges, but other companies. Data sizes are growing exponentially. So what we are trying to do at Mazars is to develop continuous audit approaches to ensure that we can manage this big data. So the reason for this is that typically audits take place during an interim stage or after year end, and working with a full year of data has immense challenges. So our continuous audit approach will subject data to testing during multiple points in the year, example quarterly or even monthly. This ensures that we keep our use of the data volumes to the lowest possible size. I will now jump into my next topic, which is the use of data analytics in auditing cryptocurrency exchanges. So before I get into this topic, the question that we should be asking before we dive into detail into how we use data analytics in the auditing of cryptocurrency exchanges is, as an audit partner of a cryptocurrency exchange, what really keeps you awake at night? Because of the rapid evolution of cryptocurrencies and the lack of formal regulations in many countries around the world, this surely is enough to keep an audit partner awake at night. So today we are lucky to have Vian Olivia, the partner and digital assets lead at Mazars, and I would like to pose this question to him. Vian?
Thanks, Dinesh. From auditing of a virtual asset service provider, there are probably three key areas that one needs to consider. The one being the digital assets sitting on the balance sheet, which is actually the cryptocurrency holding. The second is the segregation between the customer and the corporate funds, and lastly, the revenue recognition. So the big question behind all of this is, how do we know that these balances of transactions are accurate, that they are complete and they are valid?
Great job. Thanks, Vian. So ladies and gentlemen, three key words came out from Vian. That is valid, accurate, and complete. And those are three key pillars that in every audit that is done is what auditors actually need to satisfy when they look at transactions. So generally, auditors are concerned about two key risk areas in cryptocurrency exchanges. That is revenue recognition, and like Vian mentioned, the segregation of corporate and customer wallet balances by the back-end systems. So using the three keywords that Vian mentioned, I'm going to break it down into a much easier way of understanding. So from a valid perspective, validity, how do we know that the transaction that has been recorded from a revenue perspective and recorded in the customer wallet actually exists? From an accuracy perspective, how do we know that the transaction that has been recorded from a revenue perspective has been accurately calculated according to the criteria as defined by management? From a completeness perspective, how do we know that all of the revenue transactions that should have been recorded have actually been recorded? So at Mazars, we've deployed data analytics in all three of these procedures. And we do this by performing the following examples. So on the validity side, the existence of a transaction in a cryptocurrency exchange generally has two components. The one being a fiat, which is a typical hard currency, or a crypto. And generally what happens is that this asset is converted to, in the case of a fiat, it's converted into a crypto. And in the case of a crypto, it can be converted into another crypto or back into a fiat. So unfortunately, interoperability is yet to be achieved in the crypto world. So different blockchains are unable to talk to each other directly, thereby eliminating matching transactions from one blockchain to another. So we utilize data analytics to audit the fiat transactions because this is hard currency coming into a customer wallet from traditional bank accounts, as this proves the originating transaction has occurred. We then perform verification of transactions to the blockchain, depending on the crypto being acquired or swapped, ensuring that transactions are being reported, transactions being reported are actually factual. So on the accuracy component, fees are generally derived from these transactions that are mentioned just before this, and the revenue component is largely based on system logic that management runs on the back end. Our use of data analytics revolves around using the system logic to perform, in some instances, 100% recalculation of the revenue transactions. On the completeness side, this one is a little bit tricky, and while there are procedures being performed to validate that transactions exist from the blockchain, the use of data analytics is more centered around improving that the revenue generated on these trading platforms agree to revenue that is recorded in the trial balance. We, however, perform a full reconciliation of the blockchain transactions to the customer and corporate funds, ensuring that all transactions that should have been recorded have actually been recorded. So that brings me to the end of my presentation, and then I'll hand over to Vian Olivia, who is probably going to entice you to buy some NFTs. Thank you.
Thanks so much, Dinesh and Richards, for those insightful presentations. I believe it gave the listeners a fair amount to think about from a data perspective, but as well as from an auditing of this data perspective. One can also truly see the role the data plays in the fintech space with cryptocurrency exchanges and other type of virtual asset service providers. But what was also very insightful was the picture painted by Dinesh as to why auditors need to apply I2 audits when they gain assurance over these types of engagements. Now, auditors no longer are able to rely on the old methods of ticking and bashing substantive physical evidence to gain the required assurance over balances transaction. Audit has gone essentially, and it's been evolving beyond this. So operating in this ever-evolving industry of fintech and digital asset, it requires auditors to remain agile, but also to move with the times alongside the technology. So there are various regulations that govern auditors in South Africa and globally, and we need to ensure that we remain compliant with all of these laws and regulations. We also need to exercise the element of due care by ensuring that we truly understand the industry that our clients operate in. So when an auditor takes on a new client, for example, irrespective of the industry that they're operating, the auditor is required to ensure that he or she has the necessary competencies and experience to service clients in this industry, and also to mitigate the relevant risk from an audit perspective to an acceptable level. And this is an extremely important consideration. The reason why I say this is that if an auditor doesn't understand the industry of the technology, its inner workings, how to obtain the relevant assurance, the auditor is not only putting their own name and reputation at risk, they're also putting the audit profession and the cryptocurrency industry at risk. Now, as mentioned, cryptocurrency and digital assets are extremely vast topics. And this is why Mazars has invested time to understand the technology and to service the clients in this industry. But more importantly, to protect the interest of all stakeholders, not specifically the stakeholders of the entity that we're auditing, but the stakeholders of the industry as a whole. So when gaining assurance over the existence or rights and ownerships of the pseudo-anonymous blockchains, we need to take into consideration various aspects. Like when we look at something, for example, as balance build-up of various balances sitting on the balance sheet of cryptocurrencies. Cryptocurrencies such as Bitcoin operate on what we call UTXO, which stands for unspent transaction output, while Ether, the native token of the Ethereum blockchain, works on an accounting base. The differences in the nature of these two cryptocurrencies require different approaches to aggregate and harvest transactions from the various blockchains. Now, to prove stuff like rights and ownerships of cryptocurrency is not as easy as obtaining a third-party confirmation from the bank, because blockchain and cryptocurrencies were designed to operate without an intermediary. Therefore, we need to design procedures to provide us with the required assurance, which differs for each one of the cryptocurrency out there in existence. So I don't want to go into too much detail on this, but once again, this comes back to the fundamental principles of understanding the inner workings of the cryptocurrency you're actually auditing. Now, blockchain and cryptocurrency also has some pretty phenomenal attributes that auditors can use to their advantage. Any transaction executed on a blockchain is recorded on that ledger forever, which means that one can at any point in time go back in history and have a look at a specific transaction or specific flow of transactions. We also need to remember that regulations weren't designed with cryptocurrencies in mind. So we've got these set laws and regulations, and now you're dropping a 1.7 trillion US dollar asset class into these already set laws and regulations. So if we look at these areas such as accounting, for example, one needs to carefully assess the accounting framework to be sure you're applying the correct accounting framework. Now, when we look at an example, say IFRS for SMEs, which stands for the International Financial Reporting Standards for Small and Medium-Sized Entities, quite a mouthful, but they only allow one to account for cryptocurrencies as an intangible asset carried at cost, which is a bit unpractical if you're dealing in cryptocurrencies in this industry. But to make things even worse, most virtual asset service providers aren't even able to apply IFRS for SMEs because the standard doesn't allow it. It says that you can't apply the standard if you are holding funds for a broad group of people, which essentially pushes you back into IFRS. Now, of course, most individuals try to stay away from IFRS because of the technicality of the accounting standards, but also the onerous disclosure that goes along with it. IFRS, of course, has its own challenges, but the most significant challenge would once again be to see where this asset class fits into the relevant accounting standards, because one would immediately think that something like cryptocurrencies would be classified as a financial instrument, but it's not. It's not cash as defined. It's not equity of another entity. There's no contractual agreement. Of course, I don't want to bring smart contracts into this as of yet. But one needs to look at the other possible applications and see what makes sense from a practical point of view. There's also a debate on whether customer funds should be kept on balance sheet or off balance sheet, but there's various aspects that need to be considered, such as how the funds are being custodied. Is client funds being custodied in a separate on-chain address, or is it all housed in a specific public key address with the back end segregating the customer and the corporate funds or the various customer funds? Those type of considerations need to take into account. We also need to consider the tax implications of cryptocurrencies, because once again, we have this asset class that's being dropped into existing laws and regulations. Now, the topic on cryptocurrencies and tax is extremely vast, and it's probably a session on its own. And for those interested in tax treatment on cryptocurrencies, have a look at our Upskill platform. There's a designated paid webinar on cryptocurrency and tax that Di is presenting. She's the head of our national tax training. And we've also done some collaborations with Luno as well on this topic, and most likely we'll be doing something in the near future again, because cryptocurrency and tax is always something that individuals want to discuss. So I've also spoken to various non-crypto related clients over the last 6 months to advise on how they can incorporate cryptocurrencies and stable coins into their cross-border payment models and supply chains. Now, of course, for those that don't know what stable coins are, it's basically cryptocurrencies that's pegged to something like a fiat currency such as the US dollar. Now, of course, I'm not even going into CBDCs, central bank digital currencies, because once again, that's a complete discussion on its own. But cryptocurrencies such as Bitcoin is this fantastic invention because it allows us to move value over the internet in a question of minutes. But it had one flaw: it's extremely volatile. And this is why stable coins essentially were incorporated to also move over the internet in the same manner as Bitcoin, but it's not as volatile as most cryptocurrency. It's therefore able to disrupt various business models and to add an element of efficiency. Now, regulations, of course, is an extremely trending topic, not internationally, not only in South Africa, but all over the place. So we are more than likely to see regulations kick in regarding virtual asset service providers and cryptocurrencies later this year. And of course, we have received little hints here and there on what regulations could possibly look like, but nothing's really set in stone. Personally, I'm pretty excited about regulating the industry, as this would create, of course, a safer and more credible crypto industry in South Africa. But something that intrigues me a lot is the possibility of this new subsector. So over the last years, there's been a further adoption of cryptocurrencies, but interesting enough, we've also seen this institutional funds being created. Exchanges, or crypto exchanges rather, being listed on the stock exchange. So we have the scenario where these exchanges are moving from an unregulated industry to the regulated industry of actually stock exchange listings. There was also a massive hype, and still is, regarding non-fungible tokens as well, or NFTs. And the decentralized finance space is also booming. So this sets the field for what is to come when regulations kick in. Now, regulations in South Africa, of course, if designed correctly, can act as a catalyst of listed securities that hold cryptocurrencies and other digital assets as their underlying assets, and could open up a new subsector, as I mentioned. And not only has the potential to disrupt this industry, but also has the potential to further facilitate this economic growth. Now, of course, this potential, much like the technology, is limitless, and we're definitely very keen to see how this plays out as Mazars, and of course to be part of this space and working with virtual asset service providers in South Africa to make this industry more credible and make sure that they can flourish in a regulated environment. Yeah, that's it from me. I hope you guys enjoyed my piece on cryptocurrencies and regulation, everything about it. And I think the next for us is just to take a couple of questions.
Thank you, Vian, and thank you, Richard, as well as Dinesh. Now we are open to taking questions. Please feel free, you can still send through the questions in the chat, and then our speakers will take some questions. We do have a question for Richard. Richard, the question is, what are some of the biggest challenges you face as you deal with raw data?
Yeah, so I guess those challenges are universal across data teams. I think one that comes to mind is around the cleanliness of the data. So, they say 80% of a data scientist's job is related to cleaning raw data. And as you know, data comes in different formats, spreadsheets, text files, etc. And from different source systems as well. Therefore, you probably need to have a solution that's flexible enough to clean and shape the data according to your needs. Then the second one that we see is around spreadsheet usage. Naturally, big data doesn't fit into Excel files or Google Sheets. So naturally, it would need to go into a database. But some databases are kind of better at others at scaling with large data sets. So there's a challenge there as well. Sometimes you kind of outgrow the database technology that you adopt. Then, it's tough to work with millions of rows of data within spreadsheets. Or it's natural to want to move towards a SQL or Python-based environment, which has a computational cluster that does the heavy lifting for you, which for us is something that Databricks actually does quite well.
How does one?
Thanks.
All right, Dinesh, the next question is for you. How does one get into the industry of IT audit? And for example, how does one become an IT audit dealing with data analytics and big data? Also, how big is the Mazars team?
Okay, All right. Thanks, Aluta. So how does one get into the industry of IT audit? So, I mean, globally, there is one major qualification or membership or designation that can be achieved in the IT audit space. And that is CISA, which is a Certified Information Systems Auditor. It's issued by a global body called ISACA, which is based out of the US. So it's a global qualification. It's treated the same in exactly every single country around the world. But from a big data analytics perspective, you know, in terms of the data analysts which are at Mazars, primarily focused around people that have degrees in BSc mathematics, computational mathematics, statistics. We have guys with BSc information technology degrees, but primarily people focused or have done significant amount of courses or qualifications in programming, software development, SQL courses, you know, data analytics courses. That's pretty much it. And how big is the Mazars team? So currently Mazars is unique. We have a Mazars data school where we basically bring in people that are unemployed from universities and things that are battling to get a job. And we train them to actually become data analysts. So that's a good thing. So at the moment, our team is made up of, we've got probably about 15 dedicated data analysts. And we've got, at the moment, we've got about 10 interns that are going through this Mazars data school. The department is headed by myself, which is the associate director, and I have assistant managers below me that basically look after the audits.
Thank you so much, Dinesh. Our next question is for Vian. Vian, can you tell us a bit more about these proof of reserve reports that are being issued to cryptocurrency exchanges?
Yeah, sure, I can definitely do that. Yeah, so it's a quite interesting topic on what we try to achieve here. I think if we look at history, where we came from in South Africa, from a perspective of unregulated industry, of course, and some of the scams that took place in South Africa, of course, the credible virtual asset service providers out there essentially wanted to provide their customers with a type of assurance, a report that they can gain assurance that or reassure themselves that the digital assets that they actually hold with these various virtual asset service providers is actually sitting there. Because the issue that we have with some of the institutions that committed fraud, it was a case where investments were made into these institutions and the funds were misappropriated. So what you would have expected to see, you would have expected to see the cryptocurrency assets sitting on the balance sheet, and of course the corresponding liability of funds owed to the customer, which is normally the case how it works with most virtual asset service providers. So we sat and we worked with these South African virtual asset service providers to issue South Africa's first proof of reserve report. What we essentially did is we did this by way of a factual findings report, and this factual procedures that we performed to make sure that the digital assets that the clients actually hold is actually sitting on chain. So of course, there's a variety of procedures, but the focus of it is to make sure that the various cryptocurrencies that's sitting on the client's balance sheet, that we look into the various blockchains, make sure that the public key addresses actually hold that specific amount of cryptocurrencies. And more importantly as well, is that the virtual asset service providers has the private keys to the public keys of those balances sitting there. Because it's always a saying in the crypto space, not your keys, not your coins. So we actually did this report, and for the most part, we did actually verify these balances sitting either with other custody solution, was sitting on chain, or whatever the case may be. And we also looked at the corresponding liabilities, whether that liabilities is actually complete. And by putting all of this together, we put it in a factual findings report that goes onto the virtual asset service website that they can, of course, use to prove to their users and their customers that their cryptocurrency holdings is actually sitting on chain. It's not been misappropriated, or it doesn't exist, or something of that sort. And it gives them that peace of mind that goes along with the credibility linked to the virtual asset service provider.
Okay, thank you so much, Vian. We have a question for Richard. Richard, do we have tools to trace transactions through different blockchains?
Sure, yeah, so we do have different tools. One of the tools, or two of them that we integrate with, are solutions called Chainalysis and Elliptic. So what that's organizations effectively do is they group wallet addresses on the various blockchains into kind of clusters of similar behavior, and they manually label those or programmatically, but they assign certain labels to them. So, a cluster of addresses might be related to an exchange, which is obviously a positive. It's not a suspicious label. But then you might also have groupings that are related to suspicious activity. So there might be scams, there might be dark web, child trafficking, whatever. There's a whole bunch of them. So they actually go and they label these things based on police reports and all other things like that. Then they also give us access to risk scores, so based on what kind of transactional behavior they see flowing through the clusters, as well as the addresses that make up those clusters. And then they give us kind of like the USD exposure, so we can see, well, an internal customer of ours interacts with maybe a suspicious cluster. They've spent $1,000 US, then we can at least keep track of it from a transactional perspective. Then we've all got access to open source tools around this. I mean, the nature of the blockchain is it's an open ledger. We can all see the transactions that take place kind of in real time through things like blockchain.com, the Explorer that they provide, or Etherscan, which is another Explorer interface for Ethereum. And then you can see transactions and logs and ERC20 token events and things like that on Ethereum. So that data is there, and there's different ways you can actually grab that data, store it in a database, connects wallets together based on their transactional linking, and then do the tracing based off of that. Thanks.
Thank you, Richard. We have a question for Vian. The question is, do you have any thoughts on when ISA will have more defined information regarding cryptos and classification and valuation?
Yeah, so the ISA that the listener was referring to is the International Standards of Auditing. I'm not sure if they're referring to the International Accounting Standards, but if we look at the auditing standard, there's no specific changes to the standard for a specific industry. It's the normal rules essentially apply, the same with the tax. So from an auditing standard perspective, of course, the policies and the regulations were designed, and of course, irrespective of what industry you're auditing, the principles we apply. So you need to make sure that you get the relevant assurance in according with the standards. But from a accounting perspective, be it from an international financial reporting standards or the standards that's sitting into those financial reporting standards, the IFRS committee has provided a little bit of guidance in terms of exactly where cryptocurrency fits in, because they do believe that it could be seen as something like intangible asset, as we mentioned for IFRS. For SMEs, it could be something as inventory, but there needs to be a thorough assessment of exactly how to classify this. Now, of course, what I would like to see, and as I mentioned previously during the conversation we had regarding financial instruments, cryptocurrency, it moves like it, it smells like it, it tastes like it, it looks like a financial instrument. Therefore, one would expect that cryptocurrency would fall into the financial instrument standard, but it doesn't. So it's going to be interesting to see when this comes onto the radar of the committees to see, well, is there scope for us to create a new standard specifically aligned for cryptocurrencies, such as native tokens like Bitcoin, be it with NFTs, be it with smart contracts, be it with stable coins, and to create a whole standard around it, because the technology moves extremely fast. And I can to a certain extent understand why they haven't taken that step to actually design specific standards for cryptocurrencies, because of the fact that from a tax point of view, if the tax authorities try to bring in legislation to move with the cryptocurrencies, or the technology, they'll essentially be bringing a new legislation every single month, the way the technology evolves and the landscape changes. So I think what we most probably will see is once the dust has started to settle in terms of the evolution of the cryptocurrencies, and we've got a firm understanding of, okay, these are the subsectors or these are the classes of type of instruments we'll be dealing with. Probably then they will either look at incorporating something like cryptocurrencies into an existing standard, or create a whole new standard to facilitate the accounting treatment of cryptocurrencies.
Thank you, Vian. So our next question, this is for Vian and Dinesh. The question reads, one of the key concerns about cryptocurrency is its use by criminals for ransomware payments because of the assumed ease to avoid regulatory oversight and hide the recipients. However, crypto should be inherently fully auditable so that the recipient can be identified. Is it true, or what is the challenge with finding the recipient of the ransomware payments?
Yeah, so that's an interesting topic, and I mean, it's been discussed over and over again because I think cryptocurrency as a whole got a bad name because of the fact that it is, to a certain extent, I wouldn't necessarily say untraceable, but that's why we use the phrase pseudo-anonymous as opposed to anonymous, because anything can be tracked on chain. So let's say, for instance, individuals are selling or carrying on an illicit trade or something of that sort, and they get remunerated by the way of cryptocurrencies. Now, as we mentioned, the blockchain, the transactions that occurred on the blockchain is there forever on the ledger for anyone to view, and you can track every single transaction. So even though you don't know to which individual to link a specific public key address or XPub key or a specific flow of transactions or something of that sort, you can actually follow the flow of transactions. So there's various tools out there that we actually that Richard and myself discussed prior to this call that you can utilize to track and follow transactions. But of course, Bitcoin, you can't necessarily in the shop go to South Africa and pay for something in Bitcoin. So at a certain point in stage, you need to liquidate or exchange your cryptocurrencies for fiat. And to facilitate that, you need to operate through an exchange. So even though there's individuals using cryptocurrencies to either commit fraud or for illicit trade, it's probably the worst idea that you can use, because they can literally track that transaction and you can take it through multiple transactions and they can track it all the way. The technologies evolve to such an extent that also when these individuals are using mixers, that they can track the transactions past the mixers as well. And it ends up in an exchange because those individuals want cash in their pocket. They want dollar to buy real assets or whatever the case may be. And of course, from there, it goes to an exchange. So individuals can always go, authorities can always go, and they can subpoena information from the various exchanges. And the exchanges, of course, perform KYC procedures known as Know Your Client procedures. And perhaps Dinesh can tell us a little bit more about the KYC procedures. But essentially what happens is the KYC procedures being applied by these virtual asset service providers can be used to track the individual that was conducting the illicit trade. Dinesh?
Well, thanks, Vian. Yeah, so I mean, what exchanges have been doing around the world, and this is large exchanges, and this is why it's so important to use one of these large exchanges, because primarily from a trading entity perspective, these exchanges are being housed in entities which exist in countries where regulations are now existing. You know, the UK, the US, the Singapore, where there's regulations and there's validity checks, there's monitoring controls in place. So what these large exchanges have basically done is to deploy these KYC checks, validating who the customer is, where the money is coming from. And this ensures that when money is paid out or money is received, these exchanges know exactly who the money is being allocated to and where is it coming from. So it's all in the progress of regulations and all in the progress of ensuring that cryptocurrencies become more transparent and more open, thereby allowing various organizations within the country, for example, protection services like revenue services, the police services and things, to actually, based on subpoenas and court orders, can release information in respect of this.
Thank you, Dinesh. Okay, so our next question is for Richard. Richard, how do you design the tables required to keep the information in a readable and easy compliable format? How do you choose the fields for each table?
Okay, I guess it depends on the source of the data. Like I mentioned, we do have a lot of third-party integrations. There's an external company that we're working with. They're providing us with the service. We store the data that they give us, but they've already designed the data as part of their product offering. So we kind of work with what we receive from them. Obviously, we can apply some formatting and nice window dressing on top of that, but it's largely the design decisions have already been made. Otherwise, if it's an internal table, kind of designed internally by us based off of a process that we've set up, then we can obviously apply our database design principles in terms of, do we have one massive wide table? Do we kind of denormalize it and have a lot of smaller tables that are joined by some sort of kind of a star schema or something? So we can do those things. But in terms of the data fields, again, it depends on the application. I mean, some examples might be a table that gives you data on like payments, or transactions. We would have a timestamp when the transaction occurred, maybe a timestamp when it was updated or confirmed, and then we can, turn that into whatever. That timestamp can be turned into a year or a month, or you can round it to the day or to the millisecond. I mean, you've got options around that. Again, depending on the use cases in the business. We have mapping, so maybe a system will give you a 1 that equals a send and a 2 equals a receive, etc. You can then convert the mapping. In terms of values, like I mentioned, values are typically reported based on kind of the base currency that you're working with. So if it's a USD transaction, the base would be USD, but maybe you also want to convert that and equate all transactions into crypto, like Bitcoin, for example. So then you can compare transactions across the board. So that's something that you could do with a currency conversion. Integers that we receive, maybe we can apply like the actual currency in front of it, so like a USD, like actually the string. We can comma separate the every thousands part of the integer. We receive a lot of like string data, so maybe we need to kind of pass out like a substring. So like an email address, for example, maybe we just want to grab the username part of that and then store that in a particular field. These are things that we can do, obviously, based on whatever the business requirement is.
All right, thank you so much, Richard. So this is our last question, and the last question is for Vian. Vian, is there a regulatory framework or technology that can give consumers who were victims of NFT scams some recourse? Thank you.
Yeah, so I think that's a two-part question. Of course, the one focus being is there tools to track certain transactions, and the second being is there framework. So as we mentioned during the presentations tonight, and also by answering some of the Q&A questions, there definitely are tools out there that can track the transactions. Of course, with the selling of NFTs, everything happens on chain. So everything is listed on the blockchain in the ledgers. You can follow each transaction. But what we've also seen with individuals that are scamming other individuals is that usually they take the remuneration in a cryptocurrency, of course. Then there's various techniques that they can use to move the cryptocurrency through a series of public key addresses, mixers, whatever the case may be, and eventually it ends up in an exchange. Now, usually they won't use an exchange such as a Luna, for example, because Luna has very strict KYC procedures in place. They need to know who they are doing business with. These individuals that are trying to commit fraud are using exchanges domiciled in a specific country that doesn't require KYC or whatever the case may be. They only maybe require email address. So even though there are some advantages to staying anonymous, it also opens up the door for illicit trade and people to be scammed and individuals to use these exchanges for illicit trade. From a regulatory framework perspective, and this is something that we've been discussing a lot over not just the last month, probably the last 2 years, and we've been lobbying regulations for a specific reason. I think virtual asset service providers in South Africa are lobbying regulations because they want to try and weed out the bad apples and get rid of those individuals playing in this space, and they want to try to make the crypto space in South Africa, of course, a lot more credible. And the only way to do it that we found is to regulate it. I mean, every single day I hear more and more scams taking place in South Africa of individuals being scammed out of a lot of money. And this is a massive concern, because it's not, of course, great to hear that that people tell stories about being scammed in the crypto space, but it's also because of the fact that they don't properly do their research before investing in a specific vehicle or a specific scheme or whatever the case may be. The issue with Bitcoin and cryptocurrency is a lot of individuals have experienced phenomenal growth, and that element of phenomenal growth, the scam artists out there are trying to utilize. So, of course, when we create a more regulated environment, these individuals operating this space firstly needs to be registered to do so. They've got a monitoring body that has oversight of these individuals, making sure that things like they are producing financial statements, it is being independently audited. Maybe they're issuing proof of reserve reports. They need to go through a vetting process before they get a license. Individuals giving advice, of course, is also a massive concern, because it is still an unregulated industry. So anyone out there can, I mean, my mother can go give advice about cryptocurrency if someone's willing to believe her. And that's the concern, is individuals with not necessarily the expertise involved giving a financial advice to these individuals. So currently there are no regulations, and that's what we're working towards. And that's why everyone is clamoring for regulations, because we want individuals in South Africa to have recourse if something would have happened to them in terms of they got scammed out of. Well, first of all, of course, it's from prevention and detection. Regulations first will prevent individuals being scammed. But once regulations are also there, it'll also give them recourse and also detection to try and get funds back, as we have seen now with the liquidation of some of the larger scams in South Africa. But yeah, so we still have a long way to go, but I'm hoping that this will be a game changer for us in South Africa. And also, as I mentioned during the presentation, will facilitate that economic growth that we need from a cryptocurrency perspective. But yeah, I think before I just log off or whatever the case may be, I'm not sure if we're going to say goodbye as well. But yeah, thanks so much for Dinesh and for Richard for entertaining us tonight with your skill set and your knowledge. I definitely do appreciate it, and hopefully we can do one of these soon to educate the individuals out there. But yeah, thanks so much for listening tonight from my end.
Ladies and gentlemen, that brings us to the end of our webinar, and we hope you enjoyed it. Thank you so much for joining us. Good night.